Economists are slashing their forecasts for tomorrow's May jobs report after disappointing data on private sector hiring and manufacturing sparked that broad sell-off yesterday. Stephen Wieting cut his forecast for job growth last month to 100,000 from 170,000 and says the economic red flags add to growth concerns. Stephen is Citigroup's lead economist for U.S. institutional equities. Stephen, good morning to you. The housing data a couple of days ago made it official. Home prices are in a double dip. Is that where the broader economy is headed?
No, I don't think the U.S. economy is at risk of another significant contraction by any means. I mean, credit conditions in the banking sector have improved for 5 consecutive quarters. It has an important lead. Profits are high. The level of employment is 7 million below where we were back 4 years ago. You know, these are things that are positive for the outlook on a 1 to 2 year basis, but we think that this quarter is being hit quite significantly by several factors. And one of them is that you don't get a very sharp rise in energy costs like we've had without some payback. Interestingly, we're seeing some very large impact in the auto industry, very specifically to Japanese auto transplants in the U.S., both sales and production. It's very, very concentrated, and it's really an issue of the earthquake in Japan.
So, Stephen, help us to understand the investor psychology here. If the recovery, as you say, is intact on a 1 to 2 year basis, and maybe there's some short-term concerns, the stock market is supposed to be discounting out beyond the next 3 months. Why was there such a big sell-off?
Well, I think that part of this is that this QE from the Fed has been used as sort of an excuse for anything and everything. You know, what ultimately these $600 billion in Treasury purchases would mean for demand and pricing out in the future, you know, wasn't sort of the concern of a great deal of speculative activity where almost anything could be bought, particularly commodities and commodity-sensitive equities. The exchange rate moved, all of this stuff very much in advance of anything that the Fed did, and now there's some, significant profit-taking on that. We were vulnerable to a period of profit-taking and a speculative settling down, even in advance of any of these fundamental concerns.
Stephen, how is it, if what you say is true, how is it that the stock market is just waking up to the end of QE2 now? The bond market has effectively been pricing it in for the past couple of months, and instead of yields going up, yields have been coming down.
Well, that's exactly right, in the sense that, you know, QE2 has not ended. It will end at the end of this month. They're still going to essentially keep the balance sheet unchanged in size. But, we saw last year, several months in advance of actual easing steps. The first settlement of a quantitative easing purchase wasn't until November 15th of last year. August and beyond, markets were moving up, risk markets were moving up, and yields were moving up despite the promise of action from the Fed. We're seeing the reversal of that right now, but it's not as if the easing stance has already changed.
All right, Stephen, thanks for joining us this morning, adding to the perspective we've been getting on the future for financial markets after yesterday's big sell-off. Stephen Wieting, he's managing director at Citigroup Global Markets.